Let's see here. I think that we are live. So welcome back to Dapp University. So there is a lot to talk about in our stream today. We're looking at one of the largest bank failures since the 2008 financial crisis. Okay, this does not look good. We saw some real blood in the streets for the crypto markets over the weekend. We saw major stable coins like USDC lose their peg. All right, so I'm gonna tell you everything you need to know in this video today. As a blockchain developer who works with this technology on a daily basis, who watches the broader economy and finance and this entire ecosystem and what you have to understand. So if you're around here, hey, I'm Gregory. On this channel, I turn you into a blockchain master. So if that's something that you're interested in, then smash that like button down below for the YouTube algorithm, subscribe to this channel. And if you want to know how to become a blockchain master, step-by-step from start to finish, then definitely head on over to dappuniversity.com/bootcamp to start today. All right, so I got people jumping in the chat here. Let's see if we got any. Let's see here. Got it. We got Dale. Everything about stock options, technically. Let's see. Jurgensen, hope I'm saying that right. Timur, animation. Welcome. All right, so let's jump into this. I know we have not had a live stream on this channel in a while, but it felt like the right time to do an emergency update today because we have one of the largest bank failures since the 2008 financial crisis happening right now. So you might have heard what's been happening with Silicon Valley Bank or Silvergate, okay? In the marketplace. I'm going to fill you in on everything you need to understand in this video. Okay, so let's start off with setting some foundations for this. So all this kind of started to, show its face last week with a bank called Silvergate, okay, which is a crypto-friendly lender, all right? So basically what happened with Silvergate is word kind of started to spread that there was something not right, okay, with some of the contagion that's happened over the past several months in the entire crypto space with other, entities connected to the space. Again, Silvergate was a very crypto-friendly lender, and people have fears of things like, FTX going down, things going insolvent, people can't get their money back. And Silvergate announced that it was going to essentially just close down and do liquidations, okay? So that was kind of the first domino to fall that got people thinking like, hey, something's really not right here, okay? And we watched, crypto market start to just slowly bleed as these fears started to spread across social media. And so the real scare here is that, hey, if that's their first domino to fall, are we going to see contagion just like this to other banks? And could this actually be a way in which what's happening in crypto right now spreads to the broader financial ecosystem? Basically, everybody's worried about an entire systemic collapse, something like, we were on the brink of in 2008 before the Fed essentially stepped in, did bailouts, and we saw some of these people recover. But so that's kind of the initial fear. And some of those fears were confirmed just next with Silicon Valley Bank and its collapse, okay? So why is this such a big deal? Well, for lots of reasons. So, first of all, it's hitting the New York Times. This is not just a small, little, tiny regional bank that had to shut down its doors because of some bad lending practices or something like that. Basically, this was a large bank. I can't remember the rank of all the banks, worldwide, but I'm pretty sure Silicon Valley Bank was in the top 10. If I'm getting that wrong, correct me down in the comment section below. I think I saw that when I was kind of researching what was happening here. But the whole point here is this is a massive bank, all right? It had lots of different people depositing into it, notably inside the tech industry, okay? So we're talking like lots and lots of startups, lots of well-established companies who are exposed to this, and then essentially the bank just shuts down. So, for example, Roku is I don't know if you know what Roku is. Basically, it's like the like smart TVs, right? It's a really big name in the smart TV space. Roku had $487 million of its cash, or 26% of its total cash or cash equivalents, held inside of Silicon Valley Bank. And we've seen lots of other people with stories just like this. I've seen stories of startups that just raised massive rounds to the tune of, tens of millions of dollars, 20, 30, 40, $50 million. And a lot of that was just sitting in Silicon Valley Bank. And so, that has implications beyond just one bank failure and a startup collapsing. That's got to do with people who, have to make payroll inside the tech industry, people who have borrowed money from other people, who have, account receivables, have all these types of things that this contagion could really ripple out into the broader economy, not just from one isolated bank failure, okay? And how this also is impacted by other things is what's happening with the FDIC here. So if you don't know what that is, basically the FDIC is a government agency that insures deposits into bank accounts, okay? But it has limits. So basically, if you're not familiar with how this works in the United States, maybe you're not U.S. based, or maybe you are U.S. based and you just don't understand the rules. Again, I'm no expert on this, but I play by. I'll just say the rules that I play by because I think about FDIC limits when I'm banking and where I'm holding funds, which is basically. Any major established bank is going to be backed by the FDIC. And what the FDIC does is they insure deposits. So if a bank collapsed, then basically the FDIC more or less would essentially just cut you a check for money that you had deposited in that bank, unless it's above a certain limit. Or I should say it a different way, they will pay you back the amount up to a certain limit that you had deposited in that bank. And so the rules that I play by, again, I'm not an expert, but the rules that I play by is that for an individual bank is up to $250,000 per depositor in that specific bank. Even if you have multiple accounts, it's per depositor. Okay, so if you're a business, then you just get up to $250,000 of coverage. If you're an individual, you just get up to $250,000 of coverage. If you add somebody else to your account, if you're married or whatever, you can double that. If you add other, what do you call it? I forget the term here, but if you add other people who are like your heirs or something like that, you can increase your coverage. The whole point is, if you have money beyond the limits, then you're not just going to get a check cut for that amount of money, okay? So, for example, these businesses that only have up to like $250,000 of FDIC coverage, and they have like $50 million or more deposited at the bank, basically everything is not FDIC insured. And so what happens in that case is you have a case where essentially you become a creditor to the bank. And so maybe you get that money back under a certain set of conditions where maybe somebody comes in and buys the bank, and then, you might have to go through this long drawn out process to get your money back, or somebody just buys the bank and turns everything back on because, it's like their best incentive to do that. Okay. Or we see the FDIC step in, hint, I'll talk about that here in a minute. But basically this had a huge scare. Okay. Where let's say you have all these startups that raise all this money sitting in a bank, and now they can't make payroll. Okay. They got all these employees, and it's like, yeah, everybody who's got 6-figure salaries or whatever. Okay. Yeah. We're going to have to not pay you because we don't have money, right? Like all of our money just was sitting in a bank that closed down, right? That's a massive problem. So there's also legal implications with not making payroll, et cetera, et cetera. Okay. So that's the kind of fears that we're talking about. We could see mass layoffs. We could see unemployment skyrocket. We could see disastrous consequences ripple throughout the economy if this happens to one bank and then subsequently happens to more banks, because that's what the markets are worried about right now. Okay, we see banking stocks are in the toilet right now. Pretty much any big publicly traded bank is just in a sea of red. Okay. That's what the market is definitely concerned about. Is this a contagion spreading to other banks? And I'm telling you, I went into a bank kind of just to see what was going to be happening with it, like what's the actual impact on the street. You can go read about this on the internet. You can listen to a guy like me talk about it on YouTube. But I wanted to see what was actually happening. So I went into a physical bank branch, okay, and most of the conversations that I was hearing, at the front teller were essentially like people trying to get their money out. Okay, so this is spreading. This is not just like a little crypto specific issue. Like I heard a guy getting into a fight with a teller because he was trying to get his money out, and they want to require all these red tape for him to go through, and he was getting really angry about this. I mean, I don't blame him, right? Like if you have money in a bank, you should be able to get it out. But it was not a fun scene to observe. I'll put it that way. Okay. So, because that's the FDIC is a big deal. Like some people are like, hey, I don't trust the bank at all, so I want my green cash out. And most of the times, like banks cannot just give you all your green cash. Maybe you can get a few $1,000s out of them, but if you had, tens of thousands or hundreds of thousands or millions, whatever you have in your bank, right? You're not going to be able to walk out with just a stack of cash. They don't have it on hand. And so they're not going to do that. And then other people who have maybe large amounts of money in the bank are trying to get out to mitigate any losses that are not insured by the FDIC. So that's kind of the big scare because, again, Silicon Valley Bank going down is the largest bank failure since 2008, okay? Like, without a doubt, it's the largest bank failure since 2008. This is not a tiny little regional bank. This is a massive institution that, failed. So this had complications with crypto over the weekend for sure. Let's kind of talk about those. I'll just kind of pull up the chart from last weekend so we see what that looks like. Of course, we see some green in the charts. Have explain that here in a minute. But this, ever since it started to kind of happen, we saw crypto really take a nosedive. All right, we were kind of starting to have this trend, but ever since these fears started to occur, it's like boom, 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 just relentless down only. And one of the really strange things that happened that got people worked up over the weekend. I actually tweeted about this. If you want to follow some of this stuff more in real time, you can definitely go follow me over on Twitter, turn on notifications. USDC, the stable coin, lost its peg. Okay. So basically, what does that mean? So USDC is a stable coin, it's a cryptocurrency that's pegged to the US dollar. Whole idea is you should be able to swap your cryptocurrency for US dollars. It should always be pegged to $1, but it went down to 90 cents over the weekend and even lower than that. I just screenshotted this when it was at 90 cents. I think I saw it go as low as maybe like 83 cents. I don't know if you all know what the official low price was, if you saw some crazy low USDC prices in different markets. That's the thing you have to understand about crypto is it the market sets the price, and when the market doesn't trust a stable coin like this, then it can start trading well below its peg. So I think the lowest that I'm seeing on an aggregate chart here is about 86 cents, but I think I saw it as low as maybe 83 cents on some exchanges. So that's a massive discount, okay? So, of course, we see USD kind of returning to its peg. But what was the scare there? Well, essentially, USDC, the entity that backs USDC, Circle, had about $3 billion of exposure to this whole ordeal, okay? So, basically, what was the issue there? So, again, crypto is valued by the market, okay? Like, people trade it. Cryptocurrency is only worth what it's worth on an exchange because the market says, hey, here's what the price is. A Bitcoin's only worth, roughly $24,000 because the market thinks that. It's not programmed in the code. Same thing for a stablecoin. Like, stablecoins aren't programmed to keep a certain price unless they're an algorithmic stablecoin, which in case they're probably going to blow up and you should never trust them. But if you have something like USDC, the whole idea is you have an issuer. And you should always be able to go to that issuer and take your USDC and redeem it back one for $1, okay? And then the market sort of, if the market perceives the issuer to be trustworthy, then it's going to continue, trading at that. However, if the market starts to think, there's something wrong with this issuer, then you could see a discount start to take place. And that's exactly what we saw over the weekend, while we saw USDC down in the 80-something cents, because basically it came out that Circle, the issuer of USDC, essentially had about I think it was like a $3 billion hole from this whole disaster. Okay, so that being said, we have some updates on this, and let's kind of tie into those. So early this morning, let's just see here. We're starting to see some resolution to this whole deal, specifically for crypto and specifically for Silicon Valley Bank, but there's still a fear on the table of these broader banks. Okay, let's take a look at what some of this is. So basically, Silicon Valley Bank customers can fully access funds after FDIC creates a new bridge bank. Now, earlier when I was talking about this, what's the potential path forward is that you could see essentially, somebody step in either to buy the bank, and and the incentive is, well, now we bought this really successful bank, and that over time, we can make a lot of money off this. Or you see somebody like step in to create some sort of thing like this, and that's kind of what happens. So basically, depositors at Silicon Valley Bank will have full access to their money beginning Monday morning. The Federal Deposit Insurance Corporation said that's what FDIC stands for. If we talk about FDIC, that's video. That's the agency. Okay. after confirming a successful transfer of deposits to a new bridge bank. So the new bridge bank, called Silicon Valley Bank NA, it must be a naming convention that's takes place, in these types of things. Again, I'm not an expert in how these procedures take place, but that looks like maybe a possible convention. Will be operated by the FDIC. It will have normal operating opening hours, basically. Okay, all depositors of the institution will be made whole, the FDIC said. So no losses associated with the resolution of Silicon Valley Bank will be borne by taxpayers either. That's another important part. People don't want a big bank bailout where the public has to bear the tax bill for doing that, and it doesn't look like that's going to happen either. So that's one of the big reasons, all right, that we have seen a big recovery in the crypto markets after this whole fiasco has gone down. Okay, we saw this big dump followed by a really, really, really fast, rapid pump. Okay, pretty much back to our trend with Bitcoin, Ethereum, other major cryptocurrencies. We see USDC, all right, regain its peg. It's back to trading at $1. All right, more or less, right? I mean, you can easily round that up to $1. I'd way rather have this price, than 85 cents or something like that. So definitely shout out to everybody who bought a bunch of USDC at 85 cents over the weekend, and was able to redeem those back for dollars. So that's probably the single biggest piece of news that has made things kind of turn around the short term, at least for crypto, but we're not out of the woods yet for the broader banking system, and that's what a lot of people are still worried about. But let's talk about Circle as well with USDC. This is Jeremy from Circle. Okay, so basically, here's an update on USDC. Again, we saw the good news with FDIC kind of stepping in for Silverbank to make depositors whole. Of course, that would essentially apply to the whole that everybody's worried about. I say whole, W-H-O-L-E, and then whole, H-O-L-E for Circle, which everybody's worried about the USDC. So that applies to them, but then we have another update here. So basically, they're secure, but able to be accessible today. He tweeted this yesterday in the United States time. 100% of USD reserves are also safe and secure and will be made, will complete the transfer for remaining Silicon Valley Bank cash to Bank of New York Mellon. Okay. As previously shared, liquidity operation for USDC will resume at bank opening tomorrow morning, so people will be able to redeem their USDC. So that's good news as well. Okay, so basically USDC itself is not going to have a bank run where they can't get their USDC back. That's what people worry about, stablecoin issuers. They essentially are working like banks in this case, and the last thing you want is a bank run where you can't actually access their funds. That really kind of shakes the faith in a stablecoin, and that doesn't look like that's going to happen. So additionally, they're going to be bringing on a new transaction banking partner with automated minting and redemption potentially as soon as tomorrow. So that's going to smooth the process for USDC as people want to buy and sell the assets from the issuer. So they're committed to building a robust and automated USDC settlement and reserve operations with the highest quality and transparency. Now, that last part's important because I think a lot of people want a transparent stablecoin that they can trust, because stablecoins ultimately are based upon trust, all right? And it's in USDC's best interest to give people as much of what they want to make their product desirable to use, all right? So that's sort of the short-term resolution, but there are lots of other implications with this. Again, we're not totally out of the weeds from this particular situation just yet. Okay, it's good news in the short term that we see FDIC sort of step in, but that does not downplay. It really does not downplay that this is one of the largest, or it is the largest bank failure since the 2008 financial crisis. So, again, we still see the market pricing in fears of this type of thing. All right. Again, bank stocks are down like crazy. And we have stuff like this where, the banks are essentially at the center of the financial universe right now. And there's concern that the bank's runs are going to continue. Okay. I mean, we see First Republic Bank fall 60% in pre-market trading. Okay. 60%. This is not like a little cryptocurrency. A micro cap cryptocurrency. Okay, this is a established publicly traded bank. Okay, more regional banks are hit pre-market. All right, PacWest Bancorp with $40 billion in assets is down more than 20%. Okay, so we're definitely not out of the woods on this type of thing. Now, are we going to see something as bad as the 2008 financial crisis? I don't have the answer to that question, okay? But that's definitely the fear on people's mind right now. And if there's lots of things that could happen. The real scare, I think, a lot of people's minds, if we have something as bad as 2008, is that essentially, well, there's implications for crypto. Okay, there's implications for the broader economy, implications for stock market, et cetera, but you have to understand, like when 2008 happened and we saw this big, crash, we saw a lot of bank failures. One response to that essentially was, quantitative easing, all right, basically increasing the money supply and, cutting interest rates, which, led to a very large time of economic expansion, okay, that kind of, helped pull us out of that, but, had other consequences for sure, all right, but the big worry with a lot of people is that that's not really an option right now, okay? Because what we're doing right now is essentially still in this phase of monetary tightening where we're raising interest rates. Our mortgage rates are at the highest they've been in a very long time. The federal funds rate's the highest it's been in a very long time. And there's a lot of fear that you don't have that option because we don't have that far to cut rates, okay? We're not starting from a much higher place. And if we do start cutting rates, we haven't successfully got inflation under control. And essentially, if you start cutting rates now, then that could cause inflation to just go absolutely insane, okay? And I think there's a lot of people that are saying like, hey, who cares? Like, let's start cutting rates and let's start pumping the stock market in crypto, real estate, whatever, any assets. But you have to understand, you do not want a situation where inflation gets completely out of control. You do not want that situation. Even if you look paper rich, okay, that doesn't mean the purchasing power of your assets actually increases significantly, okay? Because if you divide everything by the denominator of what the U.S. dollar's value is actually worth, your actual wealth could be flat or even slightly negative, even if they decide to do something like that, okay? So, that's the real question mark. Like, what are they going to do? What are they going to do if we have a big system collapse, okay? If banks start to fail, if we see it, the economy start to continue to tank, we don't really have the lever to pull of just cutting rates without making inflation go absolutely insane. Now, there's also the counter argument that they can sort of just change the measuring stick by which they measure inflation. This wouldn't be the first time that that's ever happened, okay, that we could start excluding some of the historical data and look at more short-term time frames. But that's just really smoke and mirrors, and that's just really trying to make ourselves feel better with the numbers, potentially for political advantage, without actually fixing the underlying problem. So that's the real fear. Like, are the banks going to keep failing? And if they do, what the heck is the central bank even going to do about this whole situation? Now, let's look at what that means for crypto, too. For crypto, again, if we do start to see a coming to monetary policy, that could mean that crypto prices appreciate, okay? But that doesn't necessarily mean that that's really do anything, potentially just paper gains without any real wealth creation. But we can start to see more sort of adoption towards crypto if the faith in the banking system continues to diminish, okay? So if this whole situation plays out where the faith in the banking system continues to diminish, but we see that on-chain finance or decentralized finance or crypto, whatever you want to call it, actually is resilient through this entire thing, then that actually is a net positive for the industry as a whole. Now, over the weekend, it was a little scary when you see like one of the biggest stablecoin issuers in the marketplace, the USDC, start to show signs of weakness, okay, with its, dependence upon this bank that could potentially fail, okay? But the fact that it's recovered so swiftly is a very good thing, all right? And the fact that we're talking about increasing transparency and less dependency upon some of these other financial institutions within the crypto ecosystem is also a good thing. So basically, if we can weather this storm and actually create something that of real value during a time of economic stress and stress testing the system this way, then that is a really good thing for the entire crypto and DeFi space. And right now, I'm telling you, crypto looks like it really wants to be resilient. Okay, we're throwing some pretty serious stuff at the crypto industry right now. Okay, and it really just looks like it wants to make a recovery. All right. And a lot of people were not thinking that last week when it's just like going down, 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 down. All right. But that to me looked like people essentially just trying to mitigate risk during a time like this. All right. But, you also start to see this stuff really make a strong move in the opposite direction as soon as we get some good news on the table. One other small factor here is, there are probably some people out there that are like, hey, I don't trust my bank right now. All right. I don't trust them, even if I have FDIC insurance, et cetera, et cetera. I want to put my money somewhere else. And there's definitely some of that money going into things like Bitcoin, okay? Maybe potentially even Ether. Probably not any little tiny cap cryptos, but, I definitely think some people are viewing crypto as a safer alternative than potentially cash in a bank right now. Now, that's not going to be a widespread view. Okay, I'm not saying that like everybody's at home's like, I don't trust my bank, I'm just going to go dump it all in Bitcoin. That's not true. But there's some people that is actually probably going to be a factor right now. So that's, I think, another reason why we're seeing some resilience. But the big encouraging thing is even with some of these really nasty headwinds, the market really wants to recover. It really wants to recover. All right. So that is, that's even more confirmation that, we could have seen a potential bottom in the crypto markets and that we're establishing, the foundations for a next expansion in the crypto markets. Again, not financial advice. I'm telling you YOLO into crypto within this information, but, in the short term, that does look like a good sign for the overall market sentiment. And the other pieces that we're kind of doing that despite what's happening in the broader markets, especially with banking stocks. All right, so we got some comments in the chat here. So FATS is accumulation phase. We're going to see it fly. The professor thinks that a CBDC will be presented to us by the Fed as our savior investment. Okay, so CBDC is central bank digital currency, in case you all know what that means. Somebody said GPU market didn't drop in prices either. That's right. People want to buy them for AI. Cryptechology thinks the merge was a terrible idea for the ecosystem. Polymath thinks ETH is a security. We did see some people saying that they thought ETH is a security in their reports last week. That's just one kind of view. I don't think that ETH's going to be qualified as a security long term. Ether should have never booted miners. So, Devin Shu thinks, isn't it crazy number 3 and 5 cryptos are backed by reserves of centralized organizations? We need more algorithmic backed stablecoins. Well, the problem with that is every single algorithmic stablecoin that I've seen is absolutely blown up, okay? Absolutely blown up. People don't trust algorithmic stablecoins at all, me included, right? I'm not saying we could never see algorithmic stablecoin implementations work successfully, but as of now, it doesn't look good. I'll put it this way. I'm not holding any algorithmic stablecoins until they get proven out. So Greg says only the U.S. seems to tag everything as a security. Vitalik should just move ETH offshore and it should be fine. So I see. I understand the sentiment there. That's not exactly how it works. So Vitalik doesn't just hold the keys to Ethereum and like where it's located. So Ethereum Foundation is essentially an independent organization that is instrumental in the developing Ethereum and really supporting it. Right. That being said, the Ethereum Foundation is not a U.S. based entity. Very, very, very intentionally. Okay. And also, it doesn't just own Ethereum, all right? Ethereum is a decentralized, peer-to-peer network that's global, okay? So it's not like, it doesn't just like exist in the U.S. All right, everybody. So that's all I got for today. As always, smash that like button down below for the YouTube algorithm. Subscribe to this channel if you haven't already. That really helps these videos out so that more people can learn about blockchain. And if you're as fast in this technology as I am, you want to get your hands dirty, how can you get started today? Well, you can go to my YouTube homepage. All right, you can find those free courses there. They're like Udemy courses, but they're totally free. And if you like those and you went to the next step, or hey, maybe you want to take a master shortcut entirely, actually become a blockchain master step-by-step start to finish over at dappuniversity.com/bootcamp. Okay, you don't have to be an expert to get started today. I thought people with zero coding experience become real-world blockchain developers in a matter of months. So that's all I've got. Until next time, thanks for watching.